no matter which belief you use to explain why the market moved, the underlying reason will always be liquidity. You can use any strategy as long as you allow liquidity to be the key component. You will always be profitable because you're trading first principles, primary drivers, and causative factors. And then when you talk about smart money versus dumb money, that's when you start to realize that money flows to the manipulator from the manipulated. And in this video, I'm going to be breaking down exactly what is liquidity, what is manipulations, what inducements are, and how you can utilize it to your advantage to strengthen any strategy that you are using. And by the way, why should you listen to me? Well, I've been trading for almost a decade now. I left my career as a full-time dentist to become a full-time trader. In fact, I made my first $1 million whilst I was trading as a university student. And in fact, the same thing that I'm going to share with you today has been the exact same technicals and strategy that I've been using for the last 18 months on my public signals, where I've been calling the market live ahead of time. Over 60 signals generating 59.5% gain, verified alongside a broker sync journal and a MyFX book and live streams. A full package of complete transparency so that you know this absolutely works, and this is why you should pay attention for the rest of this video. If we reference the liquidity trading guide that I made previously, where we went through step by step exactly what inducements are, the types of inducements, the qualifications, the disqualifications, and how to be trading the right direction, because the right direction is not market structure, it's not supply and demand. The right direction is fueled by liquidity. When you start to see these inducements, as we've showcased in so many case studies, you start to see this is what's driving price. Once you identify it, despite what trend is saying, despite what supply and demand is saying, you will know which way to trade based on inducements. And the definition of inducement is twofold, where inducement not only takes out liquidity, takes stop losses, it also entices, it induces people to take action falsely in wrong areas so that they give up their stop losses also, which we'll explain in a moment. Now, there's a lot of details here where there's medium inducements, major inducements, minor inducements, POI based, non-POI based, and there's a lot of things to qualify them, for example, time based, and then the setups that come out of it. The thing I want to focus on for now is the few criteria that will help us refine it in. So when it comes to a liquidity cycle, an inducement cycle, there's going to be 4 phases. Phase 1 is going to be build up. Next is going to be our favorite, inducement. Thereafter comes reaction. And then lastly becomes mitigation. And kind of outside of the cycle, but still connected, is after the mitigation, you expect an expansion. You expect an impulse with intent because you've had a complete liquidity cycle. That liquidity cycle has engineered liquidity to then allow fast and aggressive, meaningful price action movement known as expansions. And then once you've had that expansion, then you go back to the beginning and you start the cycle again, where you have another build up, another inducement, another reaction, another mitigation, and another expansion. And these connected will be our trend. And if we reference our inducement guide, we spoke about the law of cause and effect, where the build-up and inducement, reaction, mitigation, this is the cause, the effect becomes the reaction, the expansion. And tied into that is the elastic band effect. The more you pull back the elastic band, the more meaningful that liquidity cycle is, the more meaningful that inducement is. When you let go, you expect a meaningful reaction, because you wouldn't expect to pull the elastic band and let go and nothing happen. So this is tied to reactions, and this is going to show us complete control, context, and intent in the market when we pair a liquidity cycle with an expansion. And when you see them connected in a sequence, this is known as the domino effect, which is basically once you knock that first domino, let's call it the genesis inducement, the initiation inducement, the inducement of the higher time frame. After that, to continue the trend, to go from a high in the market all the way to the low, you might have one big inducement and then smaller dominoes of multiple inducements following through all the way to the low in the market. So therefore, just like when you hit one domino, after is the next one, the next one, the next one. It doesn't matter what supply and demand Fibonacci trend is saying. You follow the inducements to read the story, to see who's in control and where they are going. As you know, I give so much back to the industry, not only where I bring leading guests for my podcast, where you can learn from professionals in the industry, where traders are following alongside me and either getting funded or actually making thousands of dollars in payouts. In fact, somebody recently commented on the video that through this channel and through the signals, they made a $30,000 payout and got funded with $300,000. This is not a rare occurrence. This happens all the time. But the reality is, if you want to really reach consistent payouts, the way to actually get profitability in the market is when someone can mentor you one-on-one on a weekly basis, sit down with you and go through your wins and losses, where they'll live stream every single day for London and New York, where you have multiple times a week Q&A sessions where you can go through any doubts you have in your strategy, and with an AI-powered platform where you can search for any concern you have, and it showcases all the videos, all the Q&As that I've done over the last few years. Is something that we offer to a select few. So therefore, if that sounds like something interesting for you, go click the link in the description and fill out the application form, just so we can see we are a right fit for each other. Best case scenario, I'll see you on a Zoom call soon. Worst case scenario, we leave you better than we found you. So therefore, when we connect everything together, the build-ups will have a few types. You might have a build-up of a range where you have equal lows and equal highs. There's going to also be Asia high or Asia low. You can also have a trend line build-up where you have a very obvious this level of trend, which can build up liquidity, because we know these are predictable stop loss areas below the support level, above the resistance level. Around this trend line, there's always going to be liquidity because there's stop losses, but also you're going to have action, because when price breaks this level, you have a break test continuation, stop losses of the sellers. You might get a break of this trend line, break test continuation. People will look to sell. The stop losses will be in this area. So they will not only take liquidity if they're broken, they will entice people to trade break and retest and get in on these patterns or trend lines, therefore fitting that definition of inducement, where you take stop losses and you invite people in. Now, there is going to be many types of build-up that we can get into around patterns, head and shoulders, Fibonacci level, EMAs, and there's going to be many complicated types. But just to give you a few examples, you can have the support and resistance version, which also encompasses Asia high, Asia low as a range. Next, you have trend line liquidity, ascending or descending. And then lastly, you have my favorite, which is a smart money trap, where you have a build-up. Smart money traders call that equal lows. After that build-up, you have a sweep. After that sweep, you have no intent, or it's at the wrong time. Look at my smart money trap guide video to understand what is the difference between an inducement and a smart money trap. And therefore, this also becomes a form of a build-up, because people are going to be looking to buy based on smart money traders' entries, and their stop losses are going to be in this area. Next, we have the inducement. So the inducement is the manipulation portion and the enticing portion, where we have this build-up, which is generating ideas. It's engineering liquidity, because people are going to react based on support and resistance, trend lines, or smart money zones. So when we are inviting people to enter based on a support level, let's say, we know that there's going to be buyers loading up on that support level and stop losses right below. An inducement is seeing that build up, knowing where the stop losses are going to be, and breaking lower. That breaking lower is naturally going to invite in a supply zone seller, a break retest level where they see that support level became resistance, and therefore they know there's going to be stop losses in that area, stop losses in that area. So the mere existence of price shooting lower to grab the liquidity of the support level, we have also invited in more liquidity, and then therefore the inducement would go on to take these guys out too. So not only do we take out the liquidity of the stop losses on the support level, but then we also enticed traders to get in and we take their stop losses too. So that inducement zone becomes that reaction point that manipulated people to get in and manipulated stop losses at the same time. A very impactful move that you will usually see around high impact times. You will see on meaningful levels and you'll have meaningful reactions. We'll go into the exact manipulation criteria in a minute, but we can start to see we have support and resistance trend line, high of previous day, low of previous day, high of previous week, low of previous week, intraday structure, major structure, session highs and lows, and then traps, for example, time related or smart money trap related. So the qualifications is going to be basically the reaction, which is the next portion, which is after we see a build up of liquidity, let's say that support level, and then we see an inducement to take out the stop losses in this area, and then also shooting up to take out the stop losses of that supply zone, the support becoming resistance, there will be stop losses in this area. This inducement that leads price to go higher and give a break of structure, this positive reaction against the trend. So we can see prior there was a bearish market, a consolidating market. This inducement allowed a bullish reaction, and therefore we had a bullish break of structure. So we basically use break of structure as the main guide to showcase intent, to showcase that reaction. Because if you're seeing bearish order flow, bearish structure, and then all of a sudden it switches, and it switches after a manipulation, you can see the law of cause and effect. You pull the elastic band back, you let go, you have a reaction. This is what we expect. So we can qualify this with also time. If you see an inducement that leads to a reaction at the right time, for example, a London Open or the New York key window, then you know you have volume in the market, you have session timing in the market, you have big players in the market. So when you have volume paired with manipulation, paired with reaction, you know you've got a lot of things coming together to showcase an intentful move. Other signs of intent apart from break of structure and time is also going to be the nature of this reaction. So for example, inside of this reaction, if we see a few other criteria, for example, imbalances, we're seeing large bullish candles leaving large imbalances. We see momentum. So the consolidation buildup is very slow and choppy, and then the inducement and reaction is very fast. We can see that this took 1 hour, this took 3 minutes. Momentum is on this side that showcases intent. Next is going to be a strong engulfing candles, strong bodied candles, and lastly is going to be follow through inducements. So if we are to take a zoom in lens and see what's going on in this area, and we see inside that area on a higher time frame is just a bullish expansion, a bullish reaction, but on the lower time frame inside of it, you see large momentum, large bullish candles, and then also fractal inducements, where we're seeing clear build up and inducements, clear build up and inducements and pushes out. Not only are we seeing momentum, not only are we seeing reaction because of the break of structure, not only are we seeing large imbalances, which is showcasing intent. So we're having a few things. We're having imbalances, we're having internal breaks of structure where we're having higher highs and higher lows. We're having also build-ups and inducements, build up and inducement, build up and inducement. This is the domino effect on a fractal nature, where the inducement and break of structure of one has in inside of it, minor inducements building up. And this is showcasing the domino effect where domino number 1, domino number 2, domino number 3, this is showcasing another form of intent. We connect it all together. And then the last thing we need to look at is mitigation. And inside that mitigation, we are basically seeing the full cycle complete, where we have the build up portion over here, we have the inducement portion over here, we have the reaction portion because it led to a break of structure and it has the intent confirmations we needed. And then we find a refined IFC, which is another video if you don't know, where price slowly comes back. You expect a choppier retracement because the intent is in the other way. And this is known as a mitigation. When you come back to the refined IFC, usually on M1 or M5, this inducement gets mitigated. We offload orders in drawdown and then you expect the next expansion. So this portion over here is the liquidity cycle, where you have your first portion, a buildup of support level. The next portion, which is the inducement to manipulate orders out of the market and entice orders into the market. Then you have the break of structure, which symbolizes the reaction. And then lastly, you have the mitigation, and this portion actually becomes the entry criteria. And then after that, you expect a explosive, volatile, meaningful reaction and expansion to complete the liquidity cycle. Now, there's going to be a few invalidations you need to pay attention to. For example, time, just like time validates, it also invalidates. If you see the signature of build-up, inducement, mitigation, but it happens during an Asia range, don't trust it. Don't trade it. This is more likely a trap. If the inducement happens at Frankfurt Open, this is a trap time and likely you found a smart money trap area. Just so you know, inside all of the SMC sweeps that exist, there exists a portion called inducements. So this is meaning to say, not every SMC sweep is an inducement, but every inducement is a SMC sweep. So when you trade SMC and it works out, it's likely you found an inducement. You are trading the profitable portion of smart money sweeps, which is known as inducements, but the greater pool of sweeps often contribute to the losses you take, which is often going to be smart money traps, which you can foresee. For example, a sweep at Frankfurt Open, a sweep at Asia high or Asia low, a sweep that is a higher high in a bullish market or a lower low in a bearish market. Or if you have other invalidations like we have here, for example, the efficiency of the pullback, which invalidates intent. It's going to look something like this. You have a build up of a support level. You have an inducement of the support level. You have a push out, doesn't break structure. And then you come back for the mitigation. This is not a valid trade because this is just showing me lower low, lower high, could go on to make a lower low. So when you have this at the wrong time or not in a POI, wrong POI, this is going to be showcasing easy ways to offset smart money traps from inducements, which is why you use the invalidation criteria like time, like efficiency of the pullback, like counter inducements to show another narrative is in control, and coming together will help you differentiate between inducements and smart money sweeps. Now, if you want to see chart examples, you don't want to be left with just theory, let me showcase a walkthrough I did of 3 weeks of price action on the lower time frame, candle by candle. And in that 3-week walkthrough, the goal was to show you every inducement and smart money trap that appeared. And in general, if you want to really solidify this concept, because it is a key pillar of any strategy, go and watch this channel. Go and watch the specific playlist that I've linked in the description, which is going to show you a full step-by-step on all the guides that I've shown you, from the market structure guide, the smart money trap guide, the liquidity guide, the lower time frame guide. Every guide that I have is listed below. So you have a full curriculum right here for you for free. And additionally, all of the case studies that I think are relevant to solidify each concept, whether it's a specific trade I took, win or loss from my public signals, or it's a 1-hour walkthrough on the 1-minute time frame, candle by candle, showing you all the trades I took for 2 weeks, wins and losses. Of course, this is paired with verification, so you know this is information you can trust and actually a working profitable strategy. But from one of my previous videos, I want to show you exactly that walkthrough, where we start to see on the higher time frame on the screen, we are on the 4-hour time frame, where we can start to see there's a lot of these things going on. Here I'm mentioning a build up, an inducement, a push out with a mitigation. This served the purpose of going bullish. Later on, what happened? A build up, an inducement lower, a push out to go bullish, and then consumed. Why did it go lower? Oh, because we took all of the liquidity of this 1, 2, 3 Asia high resistance level and smart money trap. So this inducement took control, bearish reaction, and then these inducements over here of 1 touch, 2 touch, 3 touch, 4 touches, 4 touches of support and Asia low induces into a previous inducement demand. Therefore, when you get one inducement, you get the next inducement, the domino effect, and then price expands. So when we walk through this entire price action read, go watch it in your own time. You'll see how there's inducements on every time frame, 1 minute to daily. There's going to be different fractal cycles and different showcases of intent. And I'm walking through the whole thing step by step. Go watch it in your own time because it's a very detailed case study. But you'll start to see it's all over the place. From middle of Asia range, you have a sweep. You have that push down for London session. You hit a inducement demand that had a previous expansion. Price comes in. What does it do? It induces, gives a bullish breakout, gives the mitigation. A full liquidity cycle. Build up on Asia range, inducement in London, reaction with a bullish break of structure, mitigation, and then it's a domino effect of first inducement, second inducement, and as we go a little bit further, we get another build up, another sweep, another inducement, and now that's the domino effect where you have 1, 2, and 3, and after that, what do you expect? Reaction, and expansion. And just like that, the same thing happens. So when you pair this, if you look at certain case studies like my recent one where I showcased I made $100,000 in a single month taking just 2 trades, and how they were both A+ setups, and how I was able to make not only a crazy amount of money with verification, but also showcase that this is the reason I got in. Build up, inducement, smart money traps, mitigations, trend, POI analysis, and all the guides that I have brings it all together. But as always, if you really want to learn these things and solidify it, go watch this channel. But the main thing is that if you remember, a restricted trader is a profitable trader.